When Benjamin Graham published The Intelligent Investor in 1949, he was not just writing another book on stocks. He was laying the foundation for what would later be known as value investing. More than 70 years later, this masterpiece is still considered the investor's Bible, not only because it explains how markets function but because it focuses on principles that never expire. Even in today's world of cryptocurrency, artificial intelligence, and algorithm-driven trading, the wisdom contained in its pages remains relevant. Graham's student, Warren Buffett, has often referred to it as the best book on investing ever written, a statement that reinforces its timeless authority. The reason it endures is simple. Markets change, but human behavior, fear, greed, and impatience, remains constant. This article revisits the core lessons from Graham's work, unpacking the timeless money rules that modern readers can apply to build wealth with patience, rationality, and resilience. The first and most essential money rule from The Intelligent Investor is the idea of always protecting your capital, a principle Graham explained through the concept of a margin of safety. At its core, this means that an investor should never put themselves in a position where a single mistake, market downturn, or miscalculation could wipe out their wealth. Instead of obsessing over how much money can be made, Graham insisted that investors should focus on how much could be lost. Protecting your capital matters more than chasing high returns because losses are far harder to recover from than missed opportunities. In today's world, this principle is often ignored when people pour savings into volatile assets like speculative cryptocurrencies or meme stocks driven purely by internet hype. While such bets may bring sudden gains for a few, they often lead to devastating losses for many. The practical way to honor Graham's advice is through diversification across industries and asset classes, conducting thorough research before committing money, and maintaining the patience to wait for the right opportunities rather than chasing every new trend. Protecting what you already have creates the foundation upon which wealth can grow safely and steadily. Benjamin Graham drew a sharp line between the investor and the speculator, and understanding this divide is crucial for anyone hoping to build lasting wealth. An investor approaches the market with discipline, careful analysis, and a long-term outlook, while a speculator resembles a gambler, relying on hunches, rumors, or short-term price movements. The danger lies in thinking you are investing when, in reality, you are speculating. Common signs include chasing hot stock tips, reacting emotionally to market swings, and buying assets solely because they are rising in popularity. In contrast, true investing is grounded in studying a company's financial health, evaluating its long-term prospects, and purchasing with the expectation of steady growth rather than quick profits. Real-world parallels make the distinction clear. Day trading based on intraday fluctuations is speculation, while patiently building a portfolio of undervalued stocks or index funds is investing. To adopt an investor's mindset, you must focus on stability over excitement, base decisions on evidence instead of emotions, and remind yourself that wealth grows slowly but surely over time. Graham's wisdom reminds us that speculation may look glamorous in the short run, but it is disciplined investing that ensures lasting financial security. One of Benjamin Graham's most famous teachings is the metaphor of Mr. Market, a fictional character who shows up every day offering to buy or sell shares at wildly different prices. Sometimes Mr. Market is euphoric, offering sky-high valuations, and other times he is depressed, selling for far less than the shares are worth. Graham's point was simple. The stock market is driven by emotions of fear and greed, and investors must resist being swept up in these cycles. When prices swing dramatically, most people panic or chase trends, but a disciplined investor sees volatility as an opportunity rather than a threat. Market downturns allow you to buy strong businesses at a discount, while overheated booms remind you to stay cautious and avoid overpaying. The key is to treat Mr. Market as your servant, not your guide. Listen when his price is favorable, ignore him when he is irrational. The strategies are timeless. Maintain discipline, hold a long-term perspective, and avoid emotional trades that feel urgent in the moment but prove costly later. By refusing to follow Mr. Market's mood swings, investors protect themselves from costly mistakes and turn volatility into a powerful advantage on the path to wealth. A defensive investor, as Benjamin Graham described, is someone who prioritizes safety, steady growth, and peace of mind over chasing aggressive returns. This type of investor recognizes that wealth building does not require constant risk-taking or complex strategies, but rather a disciplined and balanced approach. The core principle for the defensive investor is asset allocation. spreading investments between stocks and bonds in a way that reduces risk while still allowing for growth. For example, a typical split might be 50% in high-quality stocks and 50% in government or corporate bonds, adjusting as needed based on market conditions or personal risk tolerance. For those unwilling or unable to dedicate hours to analyzing individual companies, index funds become an invaluable tool. They offer broad diversification at low cost, aligning perfectly with Graham's philosophy of minimizing risk while capturing long-term market growth. What makes the defensive approach powerful is consistency. Sticking to the plan during both bull markets and bear markets, resisting the temptation to gamble on short-term fads. Over time, this steady, disciplined method compounds wealth far more effectively than erratic bursts of risky speculation. In essence, the defensive investor plays the long game, and that is how true financial security is built. The enterprising investor is the counterpart to the defensive investor, but instead of relying on simplicity and caution, this path demands greater effort, deeper research, and a readiness to take advantage of undervalued opportunities. Benjamin Graham emphasized that only those willing to devote time and discipline should pursue this approach, because while the potential rewards can be higher, so too are the risks. An enterprising investor looks beyond market noise, carefully screening stocks to identify companies trading below their intrinsic value. They dig into financial statements, understand industry trends, and wait patiently for bargains instead of chasing whatever is currently popular. For example, they may buy shares of a solid company temporarily undervalued due to market pessimism, holding it until its true worth is recognized. However, Graham warned that without discipline, this approach can easily slide into speculation. The rewards of active investing lie in the ability to outperform the market, but the cost is time, effort, and the risk of mistakes. Practical methods for enterprising investors include developing industry-specific knowledge, comparing valuations, and maintaining a strict margin of safety. Success comes not from excitement or luck, but from rational judgment combined with the patience to wait for the right opportunities. Benjamin Graham believed that the greatest challenge in investing was not the market itself, but the investor's own emotions. Emotional discipline, he argued, is the hidden foundation of wealth because even the soundest strategies collapse when fear or greed takes control. The most common pitfalls are easy to recognize yet difficult to avoid. Panic selling when markets fall, buying out of fear of missing out when prices soar, and following the herd even when logic suggests otherwise. Graham repeatedly warned that excitement has no place in investing. Instead, rationality must guide every decision. To master this mindset, investors can adopt simple mental frameworks. View downturns as temporary opportunities, remind yourself that price and value are not the same, and create a long-term plan to prevent impulsive moves. Writing down investment rules or keeping a checklist before buying or selling can help anchor decisions in reason rather than emotion. Another useful habit is to focus on long-term goals instead of daily price changes, reducing the temptation to overreact. By learning to control emotions, investors can turn volatility into an ally instead of an enemy, ensuring that discipline, not impulse, determines their financial future. Benjamin Graham's most famous and enduring principle is the concept of the margin of safety, often described as the golden rule of investing. At its heart, this rule means never paying full price for an asset, but instead seeking investments that are undervalued compared to their true worth. The idea is simple. By leaving a cushion between what you pay and what the asset is truly worth, you protect yourself from errors in judgment, unexpected events, or market downturns. Real-world examples are everywhere. A company with solid earnings and strong assets selling at a discount due to temporary market pessimism represents a margin of safety. Similarly, in business decisions, conservative budgeting and planning for setbacks act as a protective buffer. Graham stressed that conservative assumptions safeguard wealth because the future is unpredictable, and overconfidence is a costly mistake. For modern investors, applying this rule means buying quality stocks when they trade below intrinsic value, diversifying to spread risk, and resisting the urge to overpay for hype-driven assets. It also extends beyond investing, encouraging individuals to maintain emergency savings and avoid excessive debt. By building a personal and financial margin of safety, investors create resilience and ensure long-term success even in uncertain markets. Benjamin Graham's timeless rules, protecting capital, distinguishing investors from speculators, thinking independently of market swings, choosing between defensive and enterprising strategies, controlling emotions, and always maintaining a margin of safety, form a roadmap for building lasting wealth. Despite the rapid pace of today's tech-driven financial world, where trends come and go in hours, these principles remain as relevant as ever. They remind us that investing is not about chasing quick wins or following the crowd, but about careful analysis, patience, and rational decision-making. True financial success comes from a slow, steady, and rational approach, where discipline outweighs excitement, and long-term goals guide each move. Applying Graham's wisdom doesn't require complex formulas or constant monitoring. It starts with simple, consistent habits, diversifying investments, avoiding speculative frenzies, and making thoughtful, value-based choices. By embracing these strategies, readers can navigate modern markets confidently while building wealth that endures through volatility and uncertainty.